Okay, hi everybody. Welcome to our last session of the day. I'm Chris Brubaker, and we'll be talking about exit planning in this session. Really glad to be going last because I know I can say whatever I want to, and you guys don't care as long as we get out on time. So it relieves a good bit of the pressure as far as speaking. Um, a few things that are repeats of things you've been hearing all day. Remember, you need to be logged in for the full session and to record the 3 code words to be able to receive your CPE for this. The evaluation and all the other documents and things are on the website where you've seen them. I will look for chats if you guys have questions or would like to make any comments. Drop in a chat and I'll try to see them. If I don't see it, you can certainly unmute yourself and shout at me, and we can stop and talk about anything you guys want to. So, I mean, exit planning, I mean, we haven't really called it that, but it's something we've done for clients for a long time, but that we're trying to now develop as sort of a more formal service offering to clients. And I think it's exciting. I think it's something that we need, and the clients need a lot. And so I'm glad to be able to talk with you about it for a little bit today. So why is exit planning important? And I'm going to show you some statistics here on the next few slides. We belong to a group called the Exit Planning Institute, and most of these slides come from studies that the Institute has done. But I think these are illuminating as far as what the situation is today with business owners and why this is an important service that we can offer. This is not new. This has been going on for several years now, but there's something like 10,000 baby boomers turning 65 every day. And while people are working longer and 65 may not be a number that it used to be, it's still a pretty good marker that business owners are getting older and looking to transition to the next phases of their lives. That age cohort, the baby boomers, own something like 40% of closely held businesses in the United States. So, again, there's a lot of people who are in that cohort who are looking to transition at some point in the near future. This is one of the EPI's studies. It's a couple of years old, but I think it's still more or less accurate. It says that 76% of closely held owners plan to transition within the next 10 years. They estimate that represents 4.5 million businesses and $10 trillion of value, which are just some huge numbers, obviously. One of the obvious questions now is how COVID affects that. And I honestly don't know the answer to that question. I mean, you've heard theories that owners are saying, let me out as soon as I can get out. I don't want to deal with this anymore. Kind of on the opposite frame, owners saying, well, I plan to get out, but my business is kind of tanked in value and I need to build that up again before I can successfully get out and have something left over for myself for the rest of my life. So that probably is still up in the air, how the pandemic will affect owners' plans going forward. I did see a headline just this week that said, I think it said that both of the past 2 quarters have seen $1 trillion of M&A activity, which makes me say there's a lot of activity going on out there right now. I can say just in-house, I mean, we're certainly not dealing with anything like $1 trillion, but we've got some transactions going on that we're advising on right now. So I think there is some activity now, and there's bound to be more going forward. So again, it asks the same question: why is exit planning important? Part of the EPI studies was about what owners kind of how they had planned and whether they were ready to transition. They found that only 49% of owners had no transition plan whatsoever. They hadn't even really put any thought into it. And of the remaining, another 30%, well, they had thought about it some, but didn't have any kind of formal plan. So we're looking at about only 20% of business owners who really have a well thought out and well documented plan in place for what they want to do with their business when they're finished. That probably feeds into these next couple of bullets, that 70% of businesses that go to market are not able to sell, and that only 1/3 of sellers say their transition was successful. I thought that was pretty striking. Success was being defined as meeting the owner's personal and financial goals. I mean, I think just was the owner happy with the transaction is a good way to put it. That's a really low number. And so to ask the same question again, why is exit planning important? Because it's a huge opportunity for us as advisors to really help out our clients in an area where they really do need help, and we can provide a lot of benefit to them. What we like to say is that one way or another, every owner is going to exit his business, whether it's with guys carrying you out in a box or if you're selling your company to a bigger acquirer. Every owner of every business is going to transition at some point, and so there's a big market with a lot of people who we're able to help out, and we can make maybe that 1/3 number of successful exits go up a little bit, at least for the people that we're advising. Okay, so what do we mean by when we say exit planning? A couple of ways to wrap it up. I mean, I think it's really, at its most simple, helping our clients to understand what their options are, what the implications are of the decisions that they take as they run their business. We've sort of broken it down into a few different steps that we can take. One, what we call value enhancement. That really is helping the client understand what the business is worth right now, and then based on the owner's time frame, what steps the owner can take to make that business more valuable at the time the owner is looking to get out, and to help the owner be able to meet his goals when you get to that point. Another important thing to look at is business attractiveness, which I would kind of summarize that as saying what makes a buyer want to buy one business rather than another business. Think about things like, where you see a lot of closely held business owners saying that, I'm the most important factor in my business. This business wouldn't run without me. Everything that happens here is because I'm here and driving it, which may sound good to the owner. I mean, it makes the owner feel like he's important, and he probably is. But if I'm looking at that as a buyer, I think it's a terrible set of facts. I mean, as a buyer, I want to see a business where the owner can tell me that he plays golf 3 days a week, that he's got a management team in place, that the business more or less runs itself. He just sits back and watches. I mean, that's a more attractive business than the first business I described. One thing we like to say with this is that exit planning really is just business planning, so that the decisions that owners can make that are going to make their business stronger from a perspective of looking good to an acquirer are probably the same things that are going to make the business stronger for the owner going forward, regardless of whether they intend to sell, within the next 5 years or within the next 20 years. Last of these steps is owner readiness, which that's a more personal thing. We all know business owners who have founded businesses, who have really poured a lot of effort and a lot of their time, a lot of their work into building those businesses, making them successful. And so absolutely naturally, the owner is tied to that business. And it's tough for those owners to let go of that and walk away and really not be a business owner anymore. That really can factor into how successful an owner sees the transition as being, is whether the owner is really ready to step out of those shoes of owning a business and to move on to the next phase in life. So that's a very key matter to look at. So what we're doing today, I mean, we're really this is part of a tax conference. So what we're going to really focus on the rest of the time is on the tax aspects of business transitions. Obviously, those are always important factors. I mean, the tax will affect what the owner sees on a net basis once the transaction happens. And tax has a big effect on the new owner as well, because they want to be in a favorable position too with the business going forward. Oops, going backwards. So our first word, and I'll pause for a second to let you guys drop this in or write it down, is going to be lights. And then just a brief outline of what we want to talk about in the rest of our session today. We'll spend some time talking about, at a high level, what an equity sale is versus what an asset sale is, and how that differs in the treatment to owners, or to buyers and to sellers. We'll talk about entity tax considerations. So the form of business you're in will have some effect on what happens when you sell that business. There's a few different types of transactions that we'll talk about for an owner to get out of the business, and we'll talk about what the effects of those things are. And then I've got, I don't know, 5 or 6 different other issues that don't really fall into any of those categories that we'll catch at the end. So again, before I move on from here, I'll just make sure everybody had a chance to write down lights as the first of our CPE words. Okay, and so we'll go through this. We'll talk about equity sales and asset sales, and we'll look at what the buyer thinks about that, what the seller thinks about that. Because we're talking about exit planning, that really is more seller focused. So as we get into it, we'll sort of be more on the seller's side. But obviously, they're coming at it from different perspectives, and so their considerations in the transaction are not going to be the same. Just speaking at the highest level, I mean, a seller tends to prefer an equity sale. A buyer tends to prefer to purchase assets rather than equity. And these next couple of slides will sort of illustrate why that is. We'll start over here looking at the sellers. In general, a seller gets capital gain treatment if he sells equity. That's not necessarily always the case, particularly as we get into partnerships in a little bit. But again, as a general rule, you're more likely to have capital gain treatment in an equity transaction than in an asset sale. Once again, speaking just relatively, but comparing the two, an equity transaction can be more simple than an asset transaction. And then the seller likes it because he can avoid some liabilities if those are staying with the entity and not with the seller. And you'll see that some of these things kind of go together, right? So if we've got liability avoidance here as an advantage for the seller, that's a big disadvantage for the buyer. If he's buying equity and those liabilities stick with the business, that's going to be a big concern on the buyer side, and which leads to one of the kind of seller disadvantages. The buyer is going to demand that the seller have warranties, have holdbacks, have indemnification, do something to sort of make the buyer more comfortable with the transaction and with whatever liabilities might be involved there. As we say, that they really are sort of adverse parties in these transactions. Last of the seller disadvantages, the seller may want to retain some assets from the business and not sell everything that's there. That's difficult if you're selling equity, particularly as opposed to doing an asset sale. Moving over on the buyer side, one reason a buyer might want to do an equity transaction rather than an asset transaction is that some of those rights that the corporation has, or the entity has, if it's not a corporation, may not necessarily transfer very cleanly to a new owner if they don't stay in that same entity form. So that, if there's a contract that the corporation has, that the buyer wants to buy that, keep the contract in place, buying the equity is going to help that more so than buying assets. And retaining tax attributes we put down here, and that's obviously very limited by a lot of rules. This is not talking about Shirley rules is way beyond the scope of what we're going to talk about today. But there can be some aspects, sometimes when a buyer may be able to benefit from tax attributes that stay with a corporate entity in a transaction. Talked about liability concerns as a disadvantage. One other disadvantage is that if there's an equity sale, the basis carries over. So if something's fully depreciated on the company's books, it's going to stay fully depreciated once the buyer buys it. And so you can't really take advantage of the purchase price right away there. Okay, going to the asset sale. A lot of this will be just the exact opposite of what we saw in the last slide. For example, an advantage to the seller is if he does want to retain some assets. I mean, say the seller has a business that's operating 2 lines of business, but only wants to sell one. That's easier if you're just selling the assets, and then the seller can retain whatever assets he wants to keep. Likewise, an asset sale lets the seller maintain its entity structure it can maintain and use its own tax attributes, and so maybe the corporation that's being sold has some net operating losses. If you sell assets, we may be able to use those losses to offset some of the gain from the sale of the asset. So that's available if we're doing an asset sale, but not with an equity sale. And then we had mentioned before on the prior slide that if there are liabilities involved going over to the buyer, the seller is going to have to make a lot of representations and put warranties in place to kind of de-risk the buyer. That's not as big an issue with an asset sale because, again, the buyer really is only taking specific assets in this case, in most cases, rather than taking liabilities on. The disadvantages on the seller side are pretty substantial, though. One, whereas what we saw before is that there's a good chance you're going to get capital gain treatment with an equity sale. With an asset sale, there's a much bigger chance that there's going to be ordinary income involved, as well as a potential for double taxation, which we'll talk about kind of entity choices and how that affects tax effect later on. But double taxation is a real big issue for why a seller would prefer to sell equity rather than assets. And then, kind of to beat a dead horse again, the liability issue of those not transferring an asset sale, so the seller is still responsible for those if all he sells is assets. Going over to the buyer side, liabilities once again. Here's the basis step up, which is the flip side of what we talked about with the equity transaction. So, if I'm a buyer just buying equity, I really don't have any way to recover my purchase price in those cases. Maybe until I get out of the investment altogether, which who knows when that's going to be. Whereas if I buy assets instead, depending on what I buy, I can probably take some depreciation or some amortization and realize a benefit of what I've spent on the business much sooner than I could if it was all tied up in my basis. There's also flexibility in the structure of the business if I'm buying assets. So say I'm a buyer and I want to buy a business from a C corporation. I don't want to be a C corporation. I want to be an LLC. So I can form the LLC, use that entity to buy the business assets, and I can go ahead and operate the way I want to, regardless of how the prior business was operating. Disadvantages, this goes back to the previous slide as well. It can be difficult to transfer over some contractual rights to the buyer if it's only an asset sale, and then the loss of those tax attributes we talked about before. Okay, and so now we will go into a little bit more detail and talk about how these transactions look with some different entity types. The last session I did the international tax piece, so I missed Larry Martin's session on choice of entity, but I'm expecting I'm probably going to repeat some things that Larry said. Hopefully I'm saying the same things as he did, otherwise I fear I would be wrong. So we'll talk here about C corporations, S corporations, partnerships, which will include their LLCs when I say partnership, and then sole proprietorships, which again will include their single member entities, like single member LLCs and that definition of proprietorships. So a C corp, we'll look at both the stock sale and asset sale for all of these. I think probably the most straightforward thing we'll talk about is really a corporate stock sale. It's pretty simple. If I'm selling corporate stock, there's capital gain at the seller's level. There's not a corporate level tax on that transaction. So it really is pretty straightforward if you have a C corporation and can sell a stock. We've got some potential considerations. We'll get into ESOPs and Section 1202 a little bit further on down the outline. Tax-free reorganizations we put here because it's something to think about. Again, that's real complicated and way beyond the scope of what we've got time to talk about today. Just keep in mind that if a seller wants to take back a buyer's stock in exchange for either its equity or its assets, that may be something that would work for a corporation. But that's as much as we're really going to talk about that in our session here. If we look at the asset side, that's a good bit less favorable with a C corporation, because we see here there's a corporate level tax on that sale, which is really the primary distinction between the C corporation and the other entities we're going to talk about. There's probably not going to be a entity level tax where there is going to be here. And then here's where the double taxation comes in. To get those sale proceeds out to the owner is going to require a tax more likely than not on either a distribution or liquidation. So you're most likely to face double taxation if there is a C corporation. So that's something we would try to avoid if we're planning and have a C corporation as a client. Looking at an S corporation, on the stock side, it's really pretty similar to the C. There's still going to be no corporate level tax. There's still going to be capital gain treatment to the seller. One thing to keep in mind, though, is if you are selling stock and you're an S corporation, if the new owner wants to maintain that S election, the purchaser has to be a qualified S corporation shareholder, which mainly that's going to be an individual, certain trusts, or another S corporation can make that work. Once again, too, we'll talk about ESOPs later on. And I think you could do a tax-free reorganization with an S corp, I think, just as well as you could with a C corporation. But again, that's not what we're here to talk about today. On the asset side, there will be gain calculated at the entity level, but that gain in an S corporation, rather than the entity paying the tax, is going to pass out to the owner to pay tax at the owner's level. You do classify what that gain looks like, though, as far as what's capital gain or ordinary income at the entity level. And again, that'll pass out on the owner's K1. And then getting the money out to the owner, and this is different from the C corporation. It really just depends on what the owner's basis is, how that distribution or how that liquidation is going to look from a tax perspective to the owner. One thing to keep in mind, too, with S corporations, there could be a potential for built-in gains tax, particularly if the S elections within the last 5 years and it came from being a C corporation and there was built-in gain at that time. That's something to keep an eye on and be aware of, that there could be an entity level tax for built-in gains. You go into partnerships. If there's an equity sale, there's still going to be just tax at the partner level, not at the owner level. So that's similar to the S corporation. The biggest difference there, and again, this is kind of a repeat of something that Glenn talked about back in the partnership session just after lunch, is Section 751. So what that means is that if I sell a business, if I sell my equity, and part of what I'm selling is unrealized receivables, depreciation, if there's depreciation recapture, or if there's inventory, those things we call hot assets under the Section 751 rules. If there are those involved in my partnership, when we sell it, you sort of look through the entity to what the partnership's assets were, and those things will be taxed at ordinary income rates to me. So that's one small drawback, I guess, on a partnership side compared to an S corporation, is that there's a fairly good likelihood there could be at least a little bit of ordinary income on the sale to the owner, whereas it's most likely to be all capital gain with the stock sale. In the other assets, though, a partnership interest is a capital asset. So to the extent you don't have those hot assets, you should be able to get capital gain treatment on the sale for the owner. And then this is just kind of a side note. There was I guess this must have changed under the TCJA. Before that, if more than 50% of a partnership interest changed hands within a year, there was a technical termination of the partnership, and it was like a new partnership started. Those rules have gone away, so that's not something to be concerned about now. If there's an asset sale, this is pretty similar to an S corporation. The gain or loss is going to pass out to the partners in this case on the partner's K1. The income is going to be classified at the partner level. So, whether it's ordinary income or or capital gain will be determined at that level and then passed out to the owner. And then once again, the owner's basis is really going to determine how the distribution of those funds from the sale will be taxed. And there may be no tax if there's plenty of basis, or there may be some tax if there's a distribution in excess of the owner's basis. Last entity type we're going to get to is a sole proprietorship. Over here we see NA under equity sales, so maybe that's the most simple thing that we've talked about. That's going to be true even though, when we said we're included here as sole proprietors, single member LLCs. So even though that is still a state law entity and you can sell equity in what's treated as a sole proprietorship, I think under tax law that's still disregarded and it's still treated as if it were an asset sale rather than a sale of equity. So what happens there? Again, it's sort of similar to what we saw with partnerships. How it's taxed depends on what the assets are that I'm selling. If I'm selling those things like inventory that are going to lead to ordinary income, I'll be taxed ordinary income rates on those. If I'm selling things like goodwill, that'll be taxed at capital gain under a sole proprietorship as well. So guys, please pop up if you have any questions. Otherwise, we'll move on to some different types of transactions. And here we've kind of generally broken these down into two different categories. One's internal, so that's sort of more closely related to the seller, be it a family transfer, a sale to management or to key employees, sales to existing partners, or a sale to an ESOP, which is kind of an interesting thing to consider. And then the external transactions, which will be a sale to a third party or a liquidation. And so family transfer, kind of going back to some of the statistics we talked about earlier, I think just over half of owners say they would like to transfer their business within the family. That doesn't always work out, and we'll talk about that for some of the reasons we can see here. Sort of the advantages there, it preserves the legacy. I mean, I think owners like to say that, this business has been in our family for 2 generations or 3 generations or whatever. I mean, I think it kind of goes to that continuity that we've got listed down there below. I think it's a nice thing to be able to say that you've been able to pass that along within the family. There probably is a lower cost. I mean, there shouldn't be as much due diligence. There shouldn't be as many kind of legal and professional fees and things like that is involved with a family transfer as there might be with some of the other transactions we talk about. Both the buyer and the seller are probably motivated in a situation like this. I mean, both of those are really interested in seeing the transaction succeed. The buyer wants to see his children or whoever we're selling to succeed, and the seller obviously wants to see the business do well going forward. And then again, this is probably an advantage, and maybe depending on the owner, maybe it's a disadvantage too. But there's a potential for either a full or a partial gift where you're talking about family transfers. And so, maybe the owner isn't so much concerned about maximizing the assets he gets back for the sale. Maybe the main concern is getting wealth to the heirs or to whoever's left in the family. And you can accomplish that by doing a gift as well as you could for a sale. We're not going to talk about gifts very much. We're going to talk more about taxable sale transactions today, but that is something to keep in mind when you're dealing with family entities. Going to the flip side, you're most likely going to see a lower sales price for the owner if you're talking about a family transfer. And I think a big one is really this one about family dynamics, and there's a lot of ways to come at that. One of the classic examples, if you have, say, a business owner who has three children, one of those children is heavily involved in the business, the other 2 really are not. If the business makes up a big chunk of the owner's net worth, it makes it real tough to be fair with all 3 of those children and to kind of run the business the right way and to really be fair to all of them, the one who's working in the business and the 2 are not. So that can cause some stress in a family. You can also see stress where you have multiple members of the family working in the business. Business owners have arguments among themselves, and with a family business, those can turn into family arguments, and you can see kind of real strife there among families. And so that's, that's one of the big reasons why family businesses fail when they can. Another issue, this kind of goes back to that lower sales price. The second generation may not have liquidity to be able to make a very good deal with the owner. So there are probably going to be some concessions, maybe owner financing or slow payments to the owner getting out of it, just because they do have illiquid buyers there. And then just because the last one, there may just not be the management ability there yet for the family. And just because they're related doesn't mean necessarily are going to be the best people to run the business, and so that can be a trouble for a family business going forward. Okay, so we'll talk about here a sale to either management or to key employees, and the benefit here, the benefit of all these internal ones is really continuity. I mean, you've got sort of the same people running the business here. You have motivated buyers because really they're sort of buying their jobs, and they're motivated to keep that going on. Overall, on the disadvantage side, I think in all these internal transfers, you're going to see that there's a strong likelihood the owner is going to have to finance the transaction, because again, there's a good chance that lower kind of management below the owner level isn't going to have liquidity to be able to buy the business outright. Again, there's probably going to be a lower sales price for this than you would see if you went to the open market. The buyer may not have the entrepreneurial skill to run the business, and so you see that a lot with managers who are great at sort of the day-to-day operations things within the business, but that the higher level of strategic thinking that it takes to really run the business well may not be there yet, and so that can be a trouble with selling to management and to employees. And then what we mean by timing mismatch down there, maybe the owner is ready to get out right now, but it's a situation like we described above where the managers are really just not ready to step into those shoes right now. Or the flip side of that can be true too, where maybe the management is saying, I've got a lot of ideas, I'm eager to see this through, I've got a lot of energy, but the owner won't step out of the way. And so it's just those timing issues where that can be tough to navigate, and that's some things that you sometimes have to talk to clients about and be able to negotiate that with them and make that work out for a sale like this to work. Okay, our second CPE word is tree. And we're going to talk about sales to existing partners. Again, continuity is big here because you're really maintaining some of the same owners who were there before. Again, there's probably a lower cost. I mean, it's really a controlled process, particularly if you have a buy-sell agreement in place. That's one of those kind of last items we want to get to is buy-sell agreements. But if there's one there, and if it's well written, and it can really help with that transfer to help that be more go more smoothly. Disadvantages, again, because our sale options are really restricted, we're probably going to see a lower sale price here, probably a slower realization of the proceeds to the owner. And then the last of the internal, before I leave, so tree one more time, is our second CPE word. The last of the internal transfers is an ESOP. This is only available to corporations. So that's one disadvantage is, if you have an LLC or if you have a sole proprietorship, without jumping through some hoops, in other words, forming a corporation, you wouldn't be able to make this work. It really is, it's a good option for S corporations because S corporations don't pay tax at the corporate level, and because the ESOP trust that owns the stock is not a taxable entity, an ESOP S corporation can more or less operate tax-free. So it really is a good option to think about if you have an S corporation. Some of the advantages, and one of the big ones is employee motivation. So you're really making the owners you're making the employees rather owners in the situation, and if they can think like owners and work like owners, that can be a good tool for motivating them. I would say the flip side is true. I've got a client who's I think they're like 40% ESOP right now. They've been ESOP for a long time, but their workforce is such that it's a lot of people. They're young people. There's a bunch of turnover. They're not really thinking about retirement and not thinking about ownership at all. Our client's done a lot of trying to educate them about, hey, we're giving you something strong here and an ownership interest in this company. They just don't care. I mean, the other owners don't see any motivation at all. And so we talk to them pretty often about kind of ways for planning down the line to get out of the ESOP, because it's just not working out for them from that perspective. Another big advantage is because the corporation gets a deduction for the money it uses to fund the ESOP, you can essentially purchase the stock with pre-tax dollars. So that's a nice benefit. There's potential tax deferral under Section 1042. Again, there's a fair number of details in Section 1042, so we're not going to talk about that in too much detail right now. But I will go over a few of the top level aspects of that. It's available for C corporations only, so not S corporations. And what really happens, say I'm a C corporation shareholder, I form an ESOP, I sell my stock into the ESOP. I have to sell at least, I shouldn't say I have to sell, the ESOP has to own at least 30% of the corporation after the transaction. But if I do that, then I can reinvest my proceeds from the sale into corporate securities. And so that's either stock or debt. And sort of my basis carries over to that replacement property, and I defer my tax on the gain until later on when I sell the replacement property. It's beneficial too that the stock or debt, I mean, that can be any stock. It can be publicly traded stock. It can be other closely held stock. And so, it's a useful tool. And we've seen some clients do that and really realize some tax benefit from it when they've wanted to fund an ESOP. And then the last point on the advantages, it really is good for a partial exit. I mean, I don't know that you see very often a company going from 100% non-ESOP to 100% ESOP all at once. It's usually kind of a series of transactions that moves a bit of stock at a time into the ESOP until the owner's ready for a full exit. So it could be good for owners who are looking to kind of partly move away without getting out altogether. Some of the disadvantages, it can be expensive, it can be complicated. There's a lot of ERISA regulation of ESOPs. ESOPs have to have valuations done every year, which, because we do those valuations, we should have had that as an advantage, I guess, not as a disadvantage. But from the ESOP's perspective, it's probably not the best thing. There's a lot of rules in place, and it's really because the employees are really owners. And so the rules are in place to make sure the owner is not just using the ESOP to benefit the owner, but to benefit the employees as well. And then again, the last one, which we already talked about, was that the ESOP's only available to corporations, not to the other entity types we discussed. Okay, sale to outsiders. Here you're likely to see the highest price. And again, that's because you're just expanding the universe of who you're marketing the company to. There's more potential buyers, and so you're more likely to see higher offers. Also likely to see more cash up front than you would under the other types of transaction we talked about, and less ongoing involvement. So, we'll typically see an owner maybe have to work for the business for a year, or maybe want to work for a while under an employment contract. But he's not going to probably be as involved going forward as would be in some of those internal transactions. Over on the disadvantages side, it is a long process. There's due diligence, there's negotiation about terms. That kind of goes to the complexity and the high cost down there below as well. You're likely to spend a whole lot more money on legal and professional fees with a sale to an outsider than you are with a sale internally. The emotion to the owner, I mean, that kind of goes hand in hand with what we talked about ongoing involvement on the prior slide. The owner is really kind of getting out and stepping away from the business altogether in this situation, rather than having any kind of ongoing involvement. And so that can be tough for owners too going forward. Sorry. And then finally, liquidation. This really isn't, it's not really a sale of a business enterprise at all. It's just a sale of business selling its assets. And so where you see this is, if you have a company where there's not really any goodwill, I think the point we have here is a good option where the parts are greater than the whole. It kind of is the option when that's the case. The business is really just selling its assets and closing its doors. It's not the worst thing in the world, but it's not the best either. I mean, it probably is efficient. It's probably low cost. As a disadvantage, I mean, there's a stigma to that. I mean, that goes to the emotional piece. I mean, the owner who's in that situation has to admit that, look, I really haven't built a business here. I just am kind of selling what assets I have that I've been working with for a while, which can be tough for an owner. If you're shutting the doors, that can cause harm to employees who are not able to maybe go on and work for the buyer. And then because there really isn't any goodwill, you're not getting any compensation for that. And I would say this kind of goes to why we want to talk about doing exit planning to begin with. I mean, we've seen clients we've talked to say, hey, I'm ready to sell my business, but they just don't really have a business to sell right now. They just maybe have some equipment and a customer list. They haven't built an enterprise that somebody can step into and run and that has any value separate and apart from the owner. And so, while like I say liquidation is not the worst thing, it's something that we would like to avoid and get to one of those other transactions if we can. Okay, so sorry, some other considerations. This is kind of our catch-all area here. And we'll go into each of these in a little bit of detail in the next several slides here, the rest of the way we have today. So tax due diligence, really anytime you're having a business transaction, there's going to be some aspect of due diligence with that transaction. And tax is always going to be an important piece of that. This goes back a little bit to what we said back in one of the earlier slides that exit planning is really business planning. And so reviewing an owner's tax compliance is probably a good idea, regardless of where the owner is as far as selling the business or not. But if you can do it leading up to a sale, it can really make the transaction go a lot more smoothly if the purchaser's coming in to do due diligence and they see you've already taken care of all that, and we're all really squared away as far as our tax situation goes. And again, circling back to one of the earlier sessions this morning, you want to include a review of state and local taxes because those are becoming more and more prominent. There's going to be real traps for a purchaser, and so in due diligence, the purchasers doing that are absolutely going to take a look at the SALT when they're doing part of their diligence. The next aspect to talk about is the purchase price allocation. So what we're meaning here is that it's where you have an asset sale, it's going to be important. Where you sell a partnership interest, where we talked about you can have difference between ordinary income and capital gain depending on what the underlying assets are. It's important there too. The buyer and the seller will negotiate what what value to apply to the assets, and then they use Form 8594 to kind of document that agreement and file that with the IRS. And I think I'm not aware of the IRS really challenging a value if it's on an 8594 and if the buyer and seller both agree at an arm's length deal what it ought to be. So just kind of going into what that 8594 looks like. It shows 7 classes of assets, kind of starting with the most liquid down to the least liquid. First is cash. Second is actively traded property. So that's like stocks and securities. Third is debt instruments, and so like accounts receivable would fall into that. I don't know. We typically don't put a lot of stuff there. I mean, we're not selling cash a lot of the time. or stocks and stuff. Where you kind of get into it more is down into more of the operating type assets, working capital assets like class 4, which is inventory. Class 5 is kind of the catch-all. It includes anything that's not in one of the other 6 categories. Class 6 is Section 197 intangibles, excluding goodwill. So it's things like patents and customer lists and licenses and other things that are amortizable under Section 197, except for goodwill. Goodwill has a category of its own down in Class 7. And then the way this works, it's called the residual method. You assign value starting at the first class on down through the rest of the way until you get to Class 7 goodwill, and whatever is left just drops out in the bottom. And then the note at the bottom of this slide, and this is really a good opportunity for planning and for negotiation. I don't know, I see a lot of operating of sale agreements where it's not really very well defined. And so, if we have a seller who can say, hey, let me take the lead on doing this purchase price allocation, you can end up with some beneficial treatment that way. Okay, installment sales. This will come into play whenever you have a seller who receives proceeds in more than 1 year. Again, we talked about seller financing up there with a lot of the internal transactions. You can also see it too with a sale to a third party. One thing to think about is that sales of inventory and depreciation recapture are not available for installment sale treatment. So if I have a business and I've got some depreciated assets that have depreciation recapture there, I have to recognize the income for that depreciation recapture in the first year, regardless of when my cash comes in, which does give rise to a planning opportunity. I think if you can separately state a purchase price for those types of assets. So say I've got a business and I've got inventory and I've got goodwill and they're my only assets. If I can sell the inventory and say I'm going to take X dollars for that in year 1, and I'm going to sell the goodwill and take Y dollars for that spread over the next 3 years, I'm going to recognize the gain on the inventory in the first year anyway. So I might as well, if I can take those proceeds in the first year, that lets me defer more of the gain on those other assets that's going to be paid out in later years. So again, just a small planning opportunity there, working with installment sales. Okay, I see myself pushing up against my time a little bit, so I'm going to go through this sort of quickly. I'll be honest, I have not seen this in the wild as far as Section 1202 or Section 1245. 1045 rather. I mean, there are provisions, they've been in the law for a long time, and I think why you didn't see much before was that because the corporate tax rate was higher than it is now, and there was double taxation, it may not have been as beneficial. But now maybe with a 21% corporate tax rate, maybe it's better than it was. What it essentially is, if you have a qualified small business, and as the note said there, it has to be a SCorporation. So a qualified small business is one that issues originally issued stock. It has $50 million or less of assets at the time of the stock issuance, and 80% of those assets are used in qualified trades or businesses. If that's the case, then I can exclude up to $10 million of gain on that sale as long as I've held the stock for at least 5 years. Qualified trades or businesses, that they define that by exclusion. So it leaves out, actually, this is where, if you're familiar with the QBI deduction, Section 199A uses Section 1202 to define what a specified service, trade, or business is. So it's more or less the same there. Professional services, so accounting, legal, medical services, performing arts, athletics, banking and finance, farming, oil and gas, hotels, and restaurants are really kind of the main assets that don't qualify under this. And then Section 1045, that's for if you have qualified small business stock, but haven't held it for 5 years. If I've held it for at least 6 months, I can probably defer the gain if I reinvest my proceeds into another qualified small business. So again, sorry to push through that, but we're trying to kind of get you guys out on time. Only got a couple more slides left here. Our last word is going to be reindeer. Okay, and then buy-sell agreements we mentioned up above. This is going to be an important matter when you have a closely held business that has more than one owner. It's important for a couple of reasons. I mean, one, it stops owners from bringing on partners that they really don't want to have. And so, you know, if I'm partners with Sally and I love being partners with Sally, I have no interest in being partners with Sally's husband if Sally were to die. We can put this plan into place that, you know, I agree to buy her shares in the event of her death. That works well. It's sort of similar to what you see in a lot of operating agreements as a right of first refusal. So that, you know, again, if I'm partners with somebody and a third party offers to buy my stock, I have to give my partner the right to buy that first, just so they don't have to be partners with somebody else who's not involved with the business. It does limit the value of the business because it restricts the market for the purchasers, but it can help kind of with orderly transactions and having that planned out as long as you're thinking about those well in advance. And that's the way we can help clients out, is making sure they have these buy-sell agreements in place. Section 338H10, I don't want to talk a whole lot about that. I think I've only seen that once in my career. Kind of the benefit there is it allows a seller to make an election to treat a stock sale as if it were an asset sale. That probably is not something a seller really would want, but it could be something a buyer wants. It can get by that problem of being able to transfer contract rights because you're essentially buying the legal entity, but for tax purposes, you treat it as if it's an asset sale. And so the buyer gets the benefit of sort of both worlds on that slide we talked about up above. And so, you know, because the buyer wants it and the seller probably doesn't, it's a negotiable item for the seller and the buyer to talk about. Contingent payments, we'll kind of skip on this. You know, in most sales we see with small businesses, there could be some payments based on the business hitting its marks after the sale. Maybe there's a holdback, maybe there's an earnout that's going to have to happen before the seller is going to realize the full price on that. That does affect installment sales. There's more than we can get into today regardless, but there are some rules there as far as how an installment sale works if there is a contingent payment involved. And then this is the last slide I've got. Sellers, again, most of our small businesses are going to have a covenant not to compete involved in the sale. We usually think of that as being ordinary income, but it can be capital gain if it's really a component of the acquisition and not really compensation to the owner for not competing. And then the last point we had here was personal goodwill, which is something we've seen sometimes too, in that you know, it can be useful in a C corporation if you can say that, you know, it's not the corporation selling its assets. It's I have this asset outside of the corporation that we're using in the business. It's really my own goodwill that I'm selling, and so you can maybe avoid some of that double taxation and get capital gain treatment on that goodwill. So again, sorry to go over by a few minutes, but if anybody has any questions, please either